sure I have no battery power this time.
Maybe.
I realized I don't get a trap.
Thank you guys all for coming. We got a good crew tonight. Thank you, and I know a lot of people came from out of Lynn and Benton counties too. A lot of people from Salem and Portland and all over the place. So thank you all for coming. I'm really excited that we got a couple great speakers. I've heard them speak before, and that's why I wanted to invite them. They did a great job talking to my office a few months back. So before jumping to that, I wanted to do a real quick market update and see if anybody had questions on anything, or actually get your guys' impressions too. So I did pass out some market statistics, and I'm going to start on the back actually. So what this is, we pull some data from our MLS, and so this is on market properties. And the Willamette Valley includes the Willamette Valley MLS, which is primarily Marion, Polk, Lynn, Benton counties. I might be missing one other one, but primarily those 4 counties is what we're looking at. So you can see median sales price is $420,000 there, and I'll focus on just a few of the numbers, but that is up 6.3% from a year ago. So the numbers on the far left are comparing it to a year ago. Then we've of course got the graph. We can see that the last about roughly 3 months, that's a year, 12-month graph. The last 3 months that has come down, and then that number, the 1.2% down, is compared to a month ago. So compared to a year ago, up a little bit. Compared to a month ago, down 1%, 1.2%. Really, the numbers that I watch pretty closely are the list price received numbers. So I think that one's really interesting. In my opinion, it speaks a lot to market dynamics, because homes, we've been used to the last 2 years of seeing that at 102 to 105% on average, which means the really nice houses we're going for 110, 120% of their list price, even a year ago. Now we've come back down to reason. People are still, in general, getting what they are listing their houses for on the market, and we'll probably start to see that slide a little bit more. If you look at the front page, though, Corvallis is and Lebanon are both above 100% still, and so those have been slowly coming down off of. Corvallis was about 104% 6 months ago. You can see Corvallis is also holding its price per square foot, the next number down, and that's also, that and the median sales price are both the indicators of what value, the best indicators of what values are doing. As we think about the future, because sales prices are really looking back what happened 2 months ago, because they went under contract 2.5 months ago and sold a month ago at this point, because we're looking at October numbers. So those are a little bit more backwards looking. What I think are the more current numbers are active inventory, and thinking through that, and the month's supply of inventory. So those last two, when we say inventory, of course that means like homes that are available on the market, and so if all of a sudden we get a bunch of inventory, that's going to mean that we're going to see prices go down. And so in the large markets, what you're hearing about Las Vegas and Phoenix, Boise, and some of these other places that are actually starting to see 10% declines already in values, those are having a lot more inventory all of a sudden on the market. And I did link an article in our Facebook group yesterday that I thought was really interesting. I don't know that, because it was an outside link, I think the Facebook algorithm probably pushed it down to the bottom. It didn't really get a lot of play, but look at it on our Facebook page. Really interesting article from Fortune, and they were showing, they were attributing a lot of the value declines based on like the iBuyers, the big companies that were buying up thousands of homes in some of these markets, and all of a sudden, Zillow got out a year ago, and they put thousands of homes on the market over the last year. They were buying up their homes for themselves as iBuyers, they're called, and a few other companies that were basically really got Redfin, another one, and that's mainly who was based on an interview with the CEO of Redfin. But they're trying to get rid of those homes as soon as possible, and so they're kind of flooding the market. So inventory is going way up, and that's driving prices down. So markets that had a huge investor presence and with these iBuyers and other people trying to flip, actually are having a lot more negative consequences right now. So that being said, outlooks for 2023, there's a lot of interesting articles, and as agents, a lot of other agents are getting to hear title companies are putting on market forecasts, CE classes, and so what I'm hearing a lot is, in general nationwide, we might see 10% price declines, 10 to 15% as recessions, pending other things, and maybe 15% in kind of a more worst case scenario potentially. And this is nationwide. Of course, some of the big markets are really going to be affected that way. I think locally we're going to see minimal price declines, like under 5%. But because we've got everybody here and everybody's got a different opinion, I was going to actually just take a quick poll of everybody just to raise your hand. So I'm going to have, let's do like 4 different categories. If you think prices are going to be up in 2023, if we look a year down the road, if you think prices in general are going to be up in a year, I'd love to see. We'll do a hand raise if you think they're going to be down 0 to 5%. We'll do a hand raise for that, 5 to 10, and more than 10%. So who's in the category that thinks that home prices will actually be up in a year? Anybody? Who thinks that they're going to be down 0 to 5%? And I'll qualify that really like looking at our areas here. 5 to 10%, and 10% or more. Good. Okay, we got a good mix. Not too many people taking me up on the positive though. So, well, good. I think I introduced myself, maybe not, but I'm Ryan Long, one of the 2 hosts. At the end, we'll go around the room and let everybody introduce themselves, but I don't want to spend too much more time because we got 2 great speakers, like I said, and I'll have them come on up. They both work at Kernut and Stokes as CPAs, and so they do work with clients in tax planning. And do you have any? You've got specialties, right? Well, I'll let you guys get into that, huh? So this is John Brewer and Shelby.
Yes.
Green. Yes. Thank you guys very much for coming. Let's give them a warm welcome.
Yep, we're good.
You got one. We'll give you this guy. Sweet.
So as Ryan said, I'm Shelby Green. I'm a CPA with Kernut Stokes. I've been with them for about 3.5 years now. I know.
My name is John Brewer. I've been at Kernut Stokes for about 10 years now. I more or less specialize in real estate, timber, and manufacturing.
And then I specialize in ag, beverage, real estate, and retail. Those are kind of my key clients I work with. I just realized I have to push a button over there.
Nice. Okay.
So this is going to be. Can I have you push a button?
Yeah.
So
Or
I think just
do
hit
we
the next
want to
arrow.
try and have this
I don't know, can I
come
hit?
across? Is it
I
quite
just
long
don't
enough?
want it to fall.
Oh yes. Okay. I'll sit
If you
here.
just want to hit the next arrow,
Yeah.
that's good. Yes. So we're just going to go right in to depreciation. So we're going to be talking about depreciation, rentals, 1031 exchanges today. So for depreciation, we first have to understand what's the difference between an expenditure and what a capital expenditure is. So expense, expenditure.
At any point, please interrupt.
Yes, we love questions. It always makes it more fun when you interact with us. We've been doing these on Zoom for so long, so we love to be here in person and have you ask us questions.
More real life examples you guys can give us, the better.
Exactly. So the key point for this is that an expense is something that's not necessarily adding value to the life of your rental. So this is going to be things like painting, fixing leaks, just things to keep it up and running. And with this, this was way more important when bonus depreciation, which we're going to get into, wasn't in effect. It is phasing out, which we'll talk about, but documentation is really important. So if you ever have the IRS come back, being able to have those receipts of this is what was done, this is what was labor, this is what was supplies, just making sure that you're keeping your documentation is very, very important.
Which is better?
Right now, it's kind of here nor there with the bonus depreciation, depending on the life of the property. But as the bonus depreciation is phased out, that's when you're gonna start looking at not being able to take the full expense in the current year and having it spread out throughout the different years, so that's gonna be a little bit different tax implications.
And I'm gonna say more or less it's dependent on the taxpayer.
Yeah.
Whether you wanna expense it or kind of draw that expense out over multiple years. But generally 90% of the time you're gonna want the deduction right now, save the money so you can reinvest it elsewhere.
Yeah. So with that, even if you have some capital expenditures, there is a de minimis election that you can make every year. So that is anything under 2,500, and this is on a per asset basis, not a total. So if you, like the example says, buy $3,000 worth of computers, they're $500 each. You can just expense them all because they're all under the 2,500. So just kind of keep that in mind as you're doing these projects. If you buy a $1,000 stove, that's just an expense. It's not a capital expenditure. You don't have to depreciate it over 3-5 years. So depreciation, again, it's a deduction that is now or later. It's not something you're gonna lose. It's all about timing, and as we're gonna go into, this is a really big part of planning for your rentals versus if you expect a lot of expenditures, what that's gonna look like for you as an individual on your return. So this is definitely something to consider as you're growing any form of rental businesses, anything like that.
So just bigger picture, just simplify all this. If you spend $1,000 and you don't get an expense it right away, the IRS is going to say, hey, you can use that asset over say 5 years. They might only give you a deduction for $200 every year, even though you shoved out cash for $1,000. So this way, it's important to be able to expense it or to bonus it, to be able to utilize that $1,000 deduction to go against your tax bill immediately. So that's kind of why this is.
It's such a hot topic right now because next, bonus depreciation. Oh, one back. Bonus depreciation is going away, which is something we've been talking about. So this is for your 5-7 year life property as well as your 15-year leasehold improvements. This has been, everyone's been taking this from across our clients for a lot of their rentals and their businesses. But unfortunately, after 2022, this is starting to phase out and going back to the old system. So under those categories, starting after the end of the year, you'll be able to take 80%, so that's 80% of the cost in the current year you bought it. So this goes back to kind of what John was saying of you put the cash out, but now you can only take 80% of that deduction in the current year, and then the rest over that life of the asset. So for example, if you have $50,000 of improvements that you did in 2022 versus in 2023, that's a $10,000 difference in deduction that you can take, and depending on your tax bracket, that can be a $3,000 additional tax implication for you. So those are kind of the numbers you're going to start looking at as this bonus depreciation is going away.
Now this is as of law today.
Yes.
Who knows what's going to happen later this year or even to the January and February, but this is as today. They also could extend this out to be 100% in 2023, so on and so forth. But
so there's currently no law to make that go away. So this is the current laws. Hopefully they stay. Yeah. There you go.
Ask a question?
Yes.
So if you sell the property, say a couple of years in, you just lose the depreciation that you didn't get to access, or can you somehow recapture it?
that remaining, what we call basis, basis is what you paid for it minus the depreciation, the benefit you received against your tax return is your basis, and that's going to lower the total gain that you're going to
Okay,
have.
so you can still
Yeah,
use that.
you're not going to lose it.
But
Yeah.
you didn't realize the change.
Yeah,
Yeah.
it would just lower that gain.
Yeah, that's the thing about depreciation is you're gonna get that benefit at some point. It's just whether it's now or later.
Yeah, just time value of money. Do you
Yeah.
want it now or do you want it spread out?
Exactly. So
Thank you.
there's that. Yeah. So when we're looking at the property, and like we said, the 5, 7, and 15-year leasehold improvements are all those current ones that are in that bonus land. So these are kind of the items that you're looking for that you're going to be depreciating over that. So when you're buying those assets, when you're looking at your rental property, keep those in mind that you may not in the future be able to get the full deduction in the current year. Again, putting the cash completely out, but not getting that deduction to the bottom line on your tax return. And one thing we always have to say, we do not depreciate land. We always have to say that. Land, by the IRS's view, does not depreciate, doesn't lose its value over time. So when you buy your properties, you are gonna be splitting the cost. So if you buy it for $300,000, $100,000 might be allocated to land and 200 to the building. So then only 200,000 is going to be depreciated versus 300. So again, another thing to keep in mind when you're buying properties is the whole price might not be depreciable.
So, if I might,
Yes.
you've got computer up there 5 years. So, prior slide 2 back, you said $500, then it's within the 2,500 that you just expense. And so this would be computer equipment that is greater than 2,500.
Yes.
Just wanna make
Yeah.
sure.
We're talking big servers. For
Yeah,
some-
yeah.
But yes, you're correct. The first thing you need to think about is it under the
Is it under
dividends
25?
number?
Yeah.
And then after that, then you start worrying about all this other
All
stuff.
the life,
Yeah.
how you categorize it. So other, especially as working with rentals, there's lots of potential capital expenditures. You've got additions, you've got your landscaping, you've got exterior, adding new roofs, plumbing. These are all things to keep in mind of as you're getting them done to, again, document, keep track of your expenses, because then the total project, you might be able to deduct, especially as we're going into the bonus depreciation no longer being in effect. If you get anything done before the end of the year, you get that 100% deduction this year versus over the life of the property. And then this is also really important when we're doing cost segregations. Do you wanna next? Talk about cost segs?
Yeah, so cost saves is a really powerful tool for larger buildings, larger projects, and for tax planning purposes. So what a cost segregation does is, hey, I built a $1 million building. They're gonna come in and really piecemeal all the different components of it. They're gonna break out the plumbing, they're gonna break out the ductwork, the flooring, the insulation, all that kind of stuff into its own separate 5, 7, 15, 39-year life assets for us. And then from there, we're able to say bonus all the 5 years to get that immediate deduction now, and maybe not bonus a 7-year life assets for the future depreciation to save that. So it can turn $1 million over 39 years into, hey, we can immediately deduct 200,000 and then the rest over 39. So it's a really good way to accelerate that depreciation if you have if you have new buildings or you're constructing a building or something of that sort. It's a very powerful thing. We don't do cost segs. We're not the specialty people that do that. We contract with another company that comes in. That's all they do. They just do cost segs and they give us a nice report that stands up against audit. And it's for a lot of our larger real estate people, it's a good tool. It's a really great tool to be able to manage taxes for them and to kind of spread out that income.
Yeah, we say usually if you have a project that's over 500,000, to at least ask, see if it's worth it, if the cost benefit to it, as well as you reminded me, when we're talking about this bonus depreciation, if you are going to elect to do it, you have to elect to do it for all of the assets within that year's class. So you can't just pick and choose 3 out of your 5-year assets and say, I want to bonus depreciate these, the rest I want to depreciate over 5 years. It's either all the 5 years or none of the 5 years, all of the 7 years, none of the 7 years. So that's another thing to keep in mind is, do you want to elect out of one class and keep one class? So that's another kind of point with bonus depreciation.
That's more of the fun stuff.
Yeah.
Planning stuff.
We do a lot of planning, especially right now.
So how much is it to sell it at 25%?
The rental, we calculate your gain. It's going to depend on your basis.
Depreciation's a timing game.
Mhm.
It's you get it all at some point in fashion. So if you're taking all this immediate deduction, your gain on the back end is going to be a little bit higher. But you're able to use that tax savings now to invest into future things. So it's more of just a present value type of gain on depreciation. But yeah, you will have to pay more taxes on the back end of it. Yeah.
You can do the cost segregation up front or wait several years if it didn't exist?
It is best to do it in the year that it's built, because that's where you have all the original stuff. The guy can come in, he actually comes on site to literally walk through it and see it in person. If you buy a property, you can always have the cost seg in the year that you bought it. So if it's like this building per se, if you came in, bought this building, they can come in and do a cost seg on this building for your purchase price.
Can't do it 3 years in.
I would not advise of that, no.
Why is that?
Because there could be changes to the building. So you bought it for $1 million, 3 years later he can come in, he doesn't know what's new, he doesn't know what was established here when you bought it. So that's why.
So, if you're not a $1 million property, if you're a much smaller property, and you're not gonna pay someone to come in and do it, is that something like internally I can do, like cost segregation, like use the different things I can fall in this category and give it to my CPA? Or is that something that has to be done by a professional?
I'll make 2 comments. One being, if you do it yourself, you're opening yourself up to more risk. If the IRS ever came at you, you know your stuff, but it's a different world talking to the IRS type of video. So you're just opening yourself up to more risk that way. 2, I can almost guarantee these guys that do this for a living are going to find more deductions than what you would be able to split out.
So even say it's just a $50,000 renovation, is that still work?
Renovation, you can do that split out, that's completely fine. You know the scope of it. I'm talking like building brand new buildings.
Yeah.
And trying to break out all the pieces of that. Yeah. But if you're just doing a renovation, yeah, you don't need a cost.
You know the pieces that are going into it. You have the receipts to back that up and provide it.
For new acquisitions.
New acquisitions or new buildings, yeah.
Yeah.
That was kind of
Okay.
my leading question is that
Love it.
it's kind of late to start a construction project this year.
Yeah.
But there's still time to buy.
It is. There is still time to buy, definitely.
So like roughly how much might something like this cost? Say on a $1 million project, we're looking at hundreds of dollars or thousands of dollars or tens of thousands
It's
to have this set up?
obviously it's very variable.
Sure.
If it's a cookie cutter building that the people have done over and over and over again, it can be as low as like 4,000 to 5,000. If it's a straight up just brand new, never seen it, it could run 8 to 12 to 13 possibly.
Okay, so
It's sizable, which is why you want to be like in the bigger numbers to get that benefit immediately. Yeah.
Are there any other questions on depreciation or cost segs before we go on?
What's the lowest your basis?
0. You cannot go negative. No. Look at that.
If you know of a way, let me know.
Yeah.
I'm happy to do that.
Okay. Any other depreciation or cost seg questions? Okay. We want to touch on mortgage interest because we know, especially as you have rentals, sometimes you'll use them as collateral in a mortgage to buy other things. One thing we have to do as CPAs is we have to trace where those funds are going. So if you get a mortgage for $100,000 on your rental and you put $50,000 of that into your rental, $50,000 you go and buy yourself a new car, only 50% of those mortgage interest will be deductible on your Schedule E. So just because the rental is the collateral doesn't mean you get automatically the deduction. We actually have to trace, and we have clients where we have big spreadsheets because they spent them in 7 different places, and we have to trace where they're all going to be deducted, if at all. So keep that in mind when you're taking mortgages out. You can go ahead. And this is just a note, again, for personal, your mortgage interest deduction limitation. So if your mortgage is after 12/16/2017, you can only deduct interest up to the first $750,000. So it's just kind of a point.
Not until an LLC.
Hmm?
When it's held in LLC.
I'm talking just Schedule A, your personal residence. Yeah.
If you hold your personal residency in an LLC, it's still going to be limited to this. But if it's for investment purposes, yeah, you can forget this.
Okay. So now we're going to kind of start getting into this second home, vacation homes, rentals. So your second home. If you have a second home that you do not rent out, that you just use as a vacation outside of your primary residence, you can deduct that mortgage interest and that property taxes as well on your Schedule A. So you get 2 homes if you use them only for personal use. So again, keep that in mind. You have to make sure that you don't rent it out, except, if you want to hit next, this is one of a fun law that we found out about, the Augusta rule. So the IRS decided that if you take your personal residence or your second home and you only rent it out for 14 days or under, there's no tax consequences. You get to keep the money, you don't have to pay taxes on it. So we see this with clients, for example, in Eugene, who have the Track World Series. They'll rent out their homes. And the only qualification is it has to be reasonable rent for that time period. So if normally a house in that area would rent for $150 on Airbnb, but because the World Series or the World Track Series are going on, it's now $700,000 a month or a night, that's reasonable. And as long as it's under 14 nights, that's cash in your pocket and
Like 14 total in a year?
14 total in a year. So they can be throughout the whole year, but as long as it's no more than 14, it's still a personal residence. It's not considered a
So you
rental.
can't do Airbnb in 13 days, then 13 days, then 13.
Correct. It's 14 days total for the whole year. Good question. So I think that's a fun law that I found out about when researching this. So now if you have your second home that you rent out, that's when you're going to start dealing with some proration. So again, it's a vacation home that you use personally part of the year, and then the rest of the year you rent it out in any way that is 14 days or 10% of the days that you, or if you use it personally for 10% of the days that are rented out. So if you rent out for 180 days, you have to use it at least 18 days for it to be still considered a personal second home. So if you use it for more than the 14 days, this is where you're going to start getting into having the second home partially maybe on your Schedule A and partially as a rental on your Schedule E for taxes. And this is where you're going to have some proration of those expenses. And that's, again, documentation is going to be really important for this one. So you're going to have direct expenses. These are going to be expenses for that rental that you would only incur because it's a rental. Property management, that's the perfect one. You're only spending that money because it's a rental. Versus property taxes, utilities. You'd be paying those whether or not it was a rental. So those items you're going to have to prorate based off of the number of days that are personal and the number of days that are rental.
No, as far as these second home, the prorations, the number of days and stuff, save yourself some grief and document it as you go throughout the year. It's a lot easier that way. There's nothing worse than come March and you're trying to scramble to remember what you did in February and the prior year.
Yeah, exactly.
Try to make it as easy as possible for yourself.
So that's kind of the second homes, proration. Now we're getting into full short-term rentals, which we understand are very hot right now with the Airbnb, VRBO, and there's some interesting rules surrounding that. So the IRS has now said that a Airbnb style, if you rent it for less than 7 days on average, is actually not a rental. They are saying it is a trade or business. Why is that kind of not a great decision? If it's not a rental, you can't use your Schedule E, means your Schedule C, and you're now going to have to pay SE income on it. So you're going to have to pay 15% of SE income now because it's considered a business versus a rental. So if you are doing Airbnb and VRBO, keep that in mind that you are now going to have to treat it as if you were doing a trade or business and not just a rental activity. Yeah.
So, every December, you said I don't rent it out in December,
Mhm.
I stay in it, because I like it in December.
So, sorry, say that again?
That's how you make it a second residence? Because you're at the 30-day mark, or whatever it is, you know.
So if you've rented it out for 300 days,
Yeah.
you have to stay there for 30 days for it to be a second home.
Oh,
You still have the Schedule E portion of it,
Yeah.
but then you still get that benefit on your Schedule A for those 30-day probations.
But if it's a short-term rental, if it's an Airbnb and you just
That
want
300 is still considered trader business.
Yeah. You still have to prorate it, but you're not going to get past this
And you said it's the averaging 7 days or more.
Less.
less.
So they're looking at this as treating it almost like a hotel.
Right, but I want to be renting it on average 7 days or more.
Yeah.
Yeah.
Minimum bookings, eight days.
Mm-hmm.
You can escape this.
Yeah. So it's all those really short stays at the end of the year. That's going to be what gets you and puts you into this Schedule C business situation where you're going to have to potentially pay self-employment tax.
How do they do the average?
Number of participants by.
I would say number of participants by number of days.
Yeah.
If you had somebody stay 3 months, that's gonna skew the average pretty well.
Absolutely. Yeah.
Cool.
Yeah, exactly.
What's the best way to prove that you're using it for personal use? I mean, how are they gonna know that you're using it? You have like grocery store receipts from the store down the street, or I mean, what's the?
I don't think you want it personal use. I think the least personal use, the better for you.
Yeah, when it comes to this stuff,
When it comes to all this stuff.
the short-term rentals. If you're talking about a second home,
Right.
let's say it's in Colorado. You know, you're gonna have flights to Colorado, stuff like that, you know. So when you're talking short-term rentals where I think I would agree with John, it's not gonna be good to do personal use. Because then you're just driving, you're
Right.
taking deductions away from your business at that point, and then you're just gonna have higher income, which just means higher self-employment tax on it.
Sure.
This short-term rental thing is something that's fairly new.
Yeah.
The IRS just came out with this stance about a year ago.
Yeah.
So I think they're still kind of working through some of these kinks and hearing gripes and all that kind of stuff.
And there'll be lots of rulings and cases heard and everything, so
Yeah.
this is again, as of right now, as of what the IRS is saying, that we can advise on. I saw a hand, are you still thinking? Okay.
I have a question. So if you rent your home, your personal home out, say like a month a year on Airbnb, and then average stay is less than 7 days, then you're Schedule C.
That portion, yeah, so,
Letter of the law.
letter of law, yeah. I know, we went back and forth on this, cause it's, again, it's new, it's something that we weren't necessarily expecting from the IRS, but that's how they landed on it, is they're viewing it as a trader business and not as rentals. So, if we move to the next one. So when you're in this situation, again, this is gonna get a little in the weeds, so I'm just gonna try to do a high overview, and if you have questions, feel free to talk to us or ask questions, but essentially, if you are now a business, you now have either non-passive income, so kind of like your W-2 income, any other non-passive activities that you participate in, and then your passive income. Non-passive, you can just kind of you take those losses, offset it to the income, whereas passive, you can't take those losses. You're gonna get limited to zero potentially. So this is where you're gonna wanna figure out how much you're participating in these Airbnbs and these VRBO type situations. If you, let's say, have a rental property that is an Airbnb, but you just have a management company take 100%, they just take care of everything, you just get your check every month, you just sit back. Well, now you're a passive Schedule C, a passive trader business. So if you're in a loss, you're gonna be limited by your passive income. You're not gonna be able to take those losses. You're not gonna be able to offset those against your other non-passive income. So you're gonna have potentially a carryover year after year that you won't get the benefit of. As well as if you have income, you're gonna have to pay self-employment tax on it. So now you're gonna have to pay 15% additional tax on that income because they consider it a trader business. Whereas if you can say that you materially participate, so let's say you go in, you hire the cleaners, you go in, check everyone in, you are running your Airbnb yourself, you are spending at least 100 hours. and no one else is doing any other work on it. You're the only one working on your rentals. There's a bunch of qualifications. So again, this is a case-by-case basis, and this is where you're gonna wanna talk to a CPA about this to kind of decipher, even if it's worth considering deciphering. But if you materially participate, then it's a non-passive. Let's say you have $50,000 of a loss. You'll be able to deduct that still. Versus if you had $50,000 of a passive loss with no passive income, you just lose that for the year. And you don't get to reduce your overall income for the year by $50,000. So we don't expect, our clients to understand that. We just expect them to be able to we ask these questions: do you make management decisions? How many hours do you spend on it? And being able to answer that for us. And we'll be able to kind of guide them. Are you active? Are you material? What are the tax consequences going to be?
So that doesn't apply to real estate professionals, though?
It actually takes you out of that. So if this becomes a Schedule C, it no longer applies to that $25,000. So you don't get to take that loss.
You can group all your
You can
hours.
group it.
Yeah.
You can group the hours, but that loss, you don't get to take it with that $25,000 loss.
There's something we can probably, your case is one of those cases that we kind of sit down and talk about.
Yeah, I know. It's like I say again, this is new. We're still learning about it, but it's what they've come out with as far as regulations go.
So just to speak to, or to think about, is somebody running an Airbnb is gonna think that, hey, I'm cash flowing, why would I be worried about taking losses? So is it very likely that we're gonna have a loss, and maybe this is a way to think about depreciation and some of the other things?
Exactly. And as well as if you expect to have income, is there something? Do you have a renovation you can do to bring down your income even more? So to reduce that 15%, so you aren't paying as much self-employment tax, if any. But yeah, if you're at a loss, what are we looking at? We're gonna have to carry it over, or are you gonna be able to deduct it in the current year?
Cash flowing isn't going to necessarily mean you have taxable income.
Yeah.
They're somewhat correlated, but they're not always precise a one-for-one. So you might cash flow and then have a tax loss. Perfect world. Let's just do that every year. But it doesn't always work out that way.
It might be a dumb question, but do these rules that you've been going over, do they apply the same if you own the property in an LLC or individually? Is it pretty much the same?
Regardless of how you hold them.
Yeah.
I will plug this.
There you go.
Never hold real estate in an S corp.
Never.
Okay. Real estate 101. Never do it.
Always hold it in LLC.
Yeah. Partnership, LLC, something. Where's another question?
Why not? I got that.
You're gonna get them going on this. Go ahead.
So in an S corp, if you were to ever distribute that house out, or if you just wanted to move it elsewhere and not hold it in the business, it's gonna get counted as a sale at fair market value, and you're gonna have a big gain on it. If it's in like a partnership or an LLC, a single proprietor LLC, you can move that title, name, owner, wherever the heck you want. You can transfer from this LLC to you personally, to a different LLC. So it's just a mobility issue with it. But in S corp, you're kind of locked in. If you ever want to do anything with it, you're paying accounting at fair market value, and you're losing out on money.
Yeah.
Yeah.
Is there a question also over here? Yeah.
Mine tied with that had to do with, is that actually in how you hold title, or an election on how to be taxed? Because you mentioned that this for your self-employment tax, and if you're an LLC elected to be taxed as an S corp, you can minimize some of your self-employment tax
Correct.
via distributions as opposed to income.
Yeah.
So, in regards to holding real estate in an LLC versus an S corp, is it strictly in title compared to how you elect to be taxed?
If you hold real estate in an LLC that's being taxed as an S corp, in our world, for tax purposes, it's in an S corp.
Okay.
Is that answer?
Yeah, that's perfect.
Okay. We go between legal and tax and all.
Yeah.
There's stuff that intertwines, but for the tax purpose wise, yes, that's your answer.
It's 40,
Yeah. Oh, back one. There you go. So this is kind of what you were saying about the real estate professional. if you are able to group all of your activities, you can, as a real estate professional, take up to $25,000 of passive losses. So if you have a bunch of rentals, you have your real estate business, you meet, again, there's lots of qualifications, hours, stuff like that. Unfortunately, the short-term rentals do not get to get grouped in that. So you don't automatically get to take some of the loss. It's gonna have to flow through these, what we call passive activity loss limitations. So it's a completely separate issue now because it's a special business. So that's kind of the short term, that's the traps right now for it that we can tell. And again, because it's passive, if you don't materially participate, then you can only offset other passive income. So it might trap some of you into having these losses carried over year after year without getting any benefit. Okay, so short-term rentals. Anything else? I know they're fun. Now into 1031 exchanges. So this is a great tool that we're gonna go into as investors to help defer your gains, to hopefully be able to expand your investment portfolio, but as well as keep some cash in your pocket and take some of those taxes and defer them till later. So
Have we all heard of
1031?
1031?
Has anyone done them recently or seen one done, been a part of the transaction? Okay. So when we're talking about this, we're gonna have some terminology and a lot of them sound similar. So you're gonna have your realized gain. So that is your total gain for the transaction. Your recognized gain is the gain within the current year that you're gonna be taxed on. And then your deferred gain is just your realized gain less your recognized gain. So it's whatever portion of the gain we're gonna defer down the road until we sell that property again. And then boot is not like kind property that happens during the transaction. Often it's cash that we see.
If you don't remember us,
That's fine.
That's what you make CPAs for.
Yep.
Like,
I just want realized, recognized. I get them swapped sometimes, so just trying to remember. Realized, big picture, is the big gain. Recognized is what you are seeing this year as your gain. So what is a 1031 exchange? You are exchanging like-kind property, and the IRS has said that is real property with the same nature or character. So it is property that's used for business, for investment. This isn't your personal residence. And you can even do improved for unimproved. You can do business for investment. It just doesn't include stuff like equipment, foreign property, stocks, bonds, inventory. We're talking about real property. And then this is used again to defer your taxes. Yes? You sure? Okay. And then the cool thing about this is there's no limitation on the number of 1031 exchanges you can do. So you can, what we're gonna call stacking the gains. So you can sell one 1031 for another 1031 and keep deferring that gain until you sell that property in a non-1031 exchange transaction. So this is something that just because you did one doesn't mean when you sell that property, you're gonna have to pay those taxes. It's when you sell it in a non-1031 exchange. So keep that in mind, which is, again, you can kind of stack those. So again, no gain is recognized in exchange for solely for property. If it meets the following requirements. We're gonna go through some kind of practice problems we're gonna talk about. But one thing to keep in mind is you don't wanna do a 1031 at a loss. You don't wanna have to defer that loss. You wanna be able to take that loss in the current year. So if you think you're gonna sell at a loss, probably not a good idea to do a 1031 exchange.
that'd be really impressive. You could do it.
You could. It's not we're talking solely about gains here. Okay. So for the process, there are a lot of moving pieces when it comes to a 1031 exchange. So when you are selling what we're calling your relinquished property, so the property you currently own that you are wanting to sell, when you sell that, or when you decide to sell, you have to put the funds into a qualified intermediary. So that is someone whose literal job it is to do these exchanges. They just hold the money, make sure all the rules are followed. I don't know, I know there's someone in town, I can't remember their name, who did, I don't know if someone's used them.
I don't know of anybody in town that, title companies all make recommendations and they're mostly out of Portland and other places.
Yeah, so talk to your title person, I think.
Corvallis or Lynn and Benton counties that it is in specifically? No.
So the nice thing about it is you can start the process and decide down the road you're not gonna do it. But it's hard to go backwards. So if you're even thinking about a 1031 exchange, go ahead and talk to your title person, talk to your realtor, and get a qualified intermediary involved. Because they're gonna track those days that it takes to go from selling your relinquished, identifying your replacement, and closing on your replacement. So it is kind of something to know ahead of time if you're thinking about it, to involve all the right people. So this is kind of what I know this is the math we do that we love. So I don't expect you to know the math, but it's kind of more the bottom line of if you have a property that your basis is $125,000 that you sell for $280,000, that you then go buy a replacement property of $1.225 million. If it's in this 1031 exchange, based off of our fund calculations, you're gonna have a deferred gain of $145,000. So what does that mean to you? So that means if you didn't do a 1031 exchange, you'd be paying, depending on your tax bracket, somewhere between $21,000 and $29,000 in federal taxes on that $145,000. And you'd be paying $13,000 in Oregon tax. But because you sold it for $280,000, put all of those funds into a replacement property in a 1031 exchange, you have now deferred that until you sell this property in a non-1031 exchange transaction. So those are some big numbers that you can start thinking about.
What if you never sell it, you just die, it goes to your kids? Do they get a basis reset? Does that go away, or do they have to see?
The basis steps up to fair market value and that gains one.
Yeah.
Swap till you drop. Swap till you drop.
Yep.
Yeah, so the biggest part is if you do these, you're able to use that tax savings and reinvest it into the next property, so on and so forth.
And like I said, if you keep this property, this 1.225 for 3 years, and then 1031 exchange, sell it for 1.5 million, you're just gonna keep stacking that gain. And you're not gonna have to pay those taxes until that is sold in a non-1031 exchange
Or
transaction.
never pay it if you die.
Or never pay if you just die. So,
Second question, can you do this across state lines? Is there, just
Yeah.
pay the state taxes?
it's the type of property. So as long as it's real property for real property, you're good.
You can go 1 for 2, 2 for 1,
Yeah.
whatever you want.
Can you do a partial 1031 if the seller carries back a portion?
If the seller what?
So if the seller carries back a portion of the contract, and they do a partial 1031 with the received funds, so that they don't recognize it,
I'm gonna say yes.
right?
Just use that portion,
Alright.
that other half, and reinvest the other half, yeah. I'm gonna say yes.
Yeah, that's what I figured, we tell people.
Oh, good.
There you go.
I think the property value just has to be higher than what our transfer immediately.
So if you want to go to the next slide, an example I think kind of where you're getting at, Jesse, was the key to a 1031 exchange is you want to use all the funds from your relinquished property. That's going to help that deferred tax and not have to recognize any in the current year. So in this one, if you have a house for $300,000, you sold it for $500,000, but then your replacement was only worth $400,000, and you pocketed that $100,000 as just, you know what, it's fun money. I'm gonna go to Vegas, whatever. You now have to recognize less selling expenses, $90,000 in the current year. So,
So if you sell for 500.
500 and you bought four for 400.
Yeah, but what if your mortgage is less? Then how does it work? So if you don't
Mortgage
buy
it.
anything, you have a smaller mortgage? Because there's not that question comes up sometimes. So if you got a mortgage for 200 and then you got another mortgage for 100, which the mortgage doesn't matter. Because you don't bought a cheaper property?
Mortgage is different than basis.
Yeah,
So-
so it would still work out as zero, because you didn't recognize it?
No,
So you don't get to take your
There's still
mortgage on
gonna-
basis.
Yeah, I would just ignore the mortgage part.
Yeah. So mortgage doesn't reduce your basis. I think that's some people get confused with that. So if you have the fair market value, if you do only put 400 less selling expenses, you're gonna have to recognize 90 this year and you get to defer 100. So if you didn't defer the gain, you'd have about 28 to 38,000 in federal taxes and 17 if you didn't defer any of the gain. In the current year, you would have to pay. Even with this partial use of the funds, you now would only have to pay between 13 and 18 for federal and about 8 in Oregon. So that's deferring about 15 to 20 federal and about 9 for Oregon. And how can you get rid of still having to pay taxes in this year? Use that $100,000 that you didn't put in it, buy another property. Put it toward, even if it's not the full price, if you're using all of the funds and putting in some of your own money, you're using up all the 1031, you're deferring all of that gain.
Is that based on a calendar year? So like if you do this in May, and you buy a property in November with the extra $100,000.
It has to follow that timeline.
Oh, it has to
Follow that timeline. So we have people who will buy 2-3 plots of land,
Gotcha.
all in that same,
That-
that 40, so it's 4,580 days you have to close and be able to have that replacement property.
It can straddle 2 years though. So if you sell December and then you find and buy in February, you can.
That's fine.
It's still
So it's based on a 1031 timeline, not a calendar.
Exactly, yes.
You have exchange expenses of $10,000, I
Yeah.
think on both examples. Is that about what, is that exchange intermediary expenses?
That was just to make my numbers nice and pretty.
Okay,
I think
that's-
it's high.
okay.
There is a small fee for their services. I think it's less than 10.
This is gonna be like all of the selling costs.
15?
Yeah,
Yeah, it's a lot lower.
yeah. Do you have a question? Okay. There we go. So I think that's all we have. I know it's kind of a lot, but yes.
I've heard that 1031 exchanges are gonna be more limited in the future. Have you heard anything about that?
I think they were on the back better than if I remember correctly. And then since that didn't pass, there's been no other movements on it. Yeah, that's a good way to put it. So again, this is with current law, current stuff that we know of that's in going through the motions, but
Can you take the money into like improvements for the new property to avoid food?
Yeah. You can buy a property and then reinvest the remaining proceeds into the improvements of that property.
so as long as it's going towards that investment, you're good, yeah.
So I guess kind of along that, I think the same line, so if you're doing 1031, you sell property, and let's say you want to build a duplex. So you're using your exchange money to buy the land and then start construction. Does that construction have to be done within the 180 days, or do you somehow have longer
Pay
typically?
a big deposit. The replacement property, identifying and purchasing the replacement property, I think is the land portion of that.
Okay.
And then believe you have more time to actually pull the money out
For the
this
construction,
Yeah.
yeah.
Do you recommend doing the exchanges within the same LLC or from one to another, or does it matter?
Same owner.
What's that?
Same owner. So same LLC. LLC bought and sell.
Keep it in the same
Yeah.
LLC.
Yeah.
At least complete the transaction that way, and then if it's in a sole proprietor, single member, or partnership or whatever, then if you want to retitle, you can just move it from LLC to LLC if you want to in the end.
Okay.
How often is a property, like, if I bought a house and then I wanna do a 1032 or 1031, then another one that same year, like, is there a limit to how many you can do?
Nope, it's not like your primary residence where you have the 2-year waiting period. You can sell them, stack them, as long as it's in that 1031 transaction, it's tracked, you have the intermediary involved, then you can just do as many.
Own it for 1 year prior to the
Yeah, probably.
Wouldn't hurt.
Be safe.
Say, sure.
Yeah, I don't think you do, because the 1031 avoids taxes, whether it's short-term or long-term capital gains.
Mm-hmm.
Because you're literally just rolling the tax down the road.
Okay.
So, yeah, I think you do, because the 1031 avoids taxes, whether it's short-term or long-term capital gains.
All right.
see it that often because if you are rolling them every 6 months, you probably don't have much of a gain because you're selling all those commission expenses and all that kind of stuff.
You're probably, yeah, there's not much of a difference.
Unless you strike gold
Yeah.
over and over again. I'll be honest, I might have to look that one up. I think you were first.
Yeah, I have a real life story
Okay.
on 1031. I have a customer who had lived in a house for many, many years. His wife passed away, and then his kids were talking about maybe buying a house. So he hung on to it after he lived with his new wife, and they rented it out for about 3 years, and then the kids didn't want to buy it after they didn't have the money. So all of a sudden he was looking at this huge, huge gain. And so he ended up having to buy something else, but it never occurred to him when he started casually just renting it out that this is going to be a consequence.
Yeah, and that's a consequence of moving your primary to a rental property is after X amount of period, you're not gonna be able to hit those primary residence, exceptions, yeah, so.
B1031.
Yeah.
When I asked the question about when you dispose of something and you buy these lands, a couple years ago we did a temporary exchange and we were building the land, and we were told, yes, but within the timeline, it all has to go to an escrow account.
So you do have to complete it in the,
Well, you don't have to complete the construction.
Oh, it
but
needs-
you
Has to
go
sit in
an
that
escrow
account.
And the escrow account pays for the construction, which may exceed the timelines. You literally can't touch that money.
Yeah,
okay.
and that's where that intermediary comes in
We
handy.
did not do that, so I can't say how that all played out, but that's what we were told.
Okay, thank you.
That makes sense, yeah, holding it in escrow, they know where the funds are going.
Don't touch the cash.
Yeah.
Can you speak to, like-kind exchanges, things that would work and wouldn't work, some examples? Because I hear some people talking about like selling commercial property and then buying, bare land. And that, I mean, it really, that's all fine, right? So what are some examples of real property that wouldn't be considered a like-kind?
If it's your personal residence. If it's,
You can't do it if it's your personal residence. So the first caveat is it has to be investment/business type of property. It can be single-family residence, it can be apartments, it can be commercial property, it can be land, it can be developed land, and then you can swap within all of that, all of those different categories freely. But you can't go single-family residence to a yacht in California because that's not real property. Can you think of anything else besides those ones?
yeah, I think, or
What are the business, like some of the business stuff?
business, what do you mean?
You can't, if you have a rental property that you're renting out to people, you can't go and buy yourself a vacation house and use it personally.
So that does bring up another question. I have heard of people like having investment property and then saying, I'm gonna go buy 1031 to a property in Arizona, rent that out for 2, 3, 4 years as a rental, and then decide that they want to retire there. Does that work, or are there any consequences of that? Nope.
That's all I'll say about that one.
Yeah, that's a research question. Yeah. Yeah. I
What
mean,
about like tiny houses, mobile homes manufactured? How does that play? Is that still considered real property? It's just kind of a gray area for.
Tiny homes for me is personal property. It's just like an RV. RV is
It's like
personal
anything that can
property.
move.
Yeah. If it's adhered to the ground, I think you're
That's
pretty
real
safe.
property.
Pretty safe calling it
Yeah.
real property. Yeah.
What about doing a 1031 for a second? So you know, vacation maybe, we purely short-term rental, you go there occasionally, but can you 1031 that after a short-term years?
If it's business for business, you can do it.
Yeah.
If you're going business to personal use, I would
If it's
say like
100% only a second home, you don't rent it out at all. You wouldn't be able to do that.
So it'd have to be.
It have to be some
there
form of
for
a rental.
business.
Yeah. So whether that's short term or long term with some personal days sprinkled in, but you have to, it has to have some form of the investment or business purpose.
Okay.
And it has to be on the ground or be ground, attached to the ground. Okay.
I was able to capture a fair amount of notes, but are these slides going to be able to refer back to somewhere online?
I can give Brian some PDFs of the slides, so that way you guys can refer back to them.
I think you still have to recapture that
You do,
depreciation.
yeah. You still have to, so because you take depreciation once it's a rental, you still have to recapture that, so that has reduced your basis essentially in the house. So you're still gonna have a bigger gain.
Yeah, you could have that exclusion if you're in that window.
Right.
And then keep in mind if those 2 years were when he was single, it's only that 250
Right.
versus, I'm not sure with death and everything, that gets into estate and trust, which are
Right,
a whole
right,
nother
right.
ballgame.
Right.
If he was with his wife during that time, if that would include that 500,000.
So then the second question, kind of going back to some folks talking about the Arizona things like that. So for those folks that are thinking about doing that type of thing, is it better for that to be a second home that's just a personal second home, or is it better to turn it into a rental if you're going to be renting it out for more than 14 days? From a tax perspective.
Well, you can't do the 1031 if it's personal at all.
Just
In
fine.
general.
Just generally fine.
Less personal days better.
Right. Then it simply is the rental road.
But as a schedule, you don't pay SE income on it,
Right.
so there's that. And you don't prorate.
You run it yourself.
Bring it to yourself.
Yeah.
There are rules
Give
against
yourself cash.
there, and if related parties as well falls into that. So that, again, so
Right.
getting into the weeds, you're gonna, if you can't rent it to your sister.
Right.
And then say, I'm gonna rent to you for $50 a day when really rent's going
Fair
for,
market value.
yeah.
Fair price.
Yeah. So, you're getting into some, definitely some weedy stuff there.
They're fun scenarios to play out with.
That's
but
what we
it's-
love to do.
Yeah, it's one of those things, you sit down and you run through a bunch of scenarios with all the facts and what the end goal is, and get you from point A to the end goal, and see where
Right.
you can. Yeah.
Yes.
You're figuring out the, like, this is for depreciation, the like 27.5 years. When you're looking at a rental property and figuring out what percentage of the lot is land, what percentage is structure, you guys look at like the appraisal or the like tax assessor. I've heard of people getting like kind of shady with like estimating stuff that's like not correct and then getting like burned
Yeah.
and having to pay a lot.
Unless we have better information, we just go off the property tax statement.
Yeah.
Okay.
County, if the government agency themselves have a split,
Let's say X amount is.
probably has to be good for the IRS.
Yeah.
But if you have expertise in the area, and you want to kind of allocate it a different way.
You just essentially have to be able to back that up. So when you're making those type of decisions, when it comes to like the business side or rentals, like just think about, am I gonna be able to defend this to the IRS?
Yeah.
And your word's not necessarily enough.
Yeah.
You have to have some sort of support documentation for it.
Property tax, it's very
Yeah.
standard for us to pull property
Yeah.
reports.
Okay.
Is your depreciation set from a sales price over 27.5, or is it you can change it at any point, or it's just reset at sale every time?
Without regard to the 1031s,
Without regard to just depreciating?
just depreciation in general.
Yeah.
You're gonna buy a property and you're gonna depreciate that over 27.5, and then whatever you improve on it throughout the years, that'll get its own different life.
Okay,
Per
so
se.
it's linear.
Yeah.
Yeah.
If you refi it, would you get a higher valuation there on it?
Depreciation won't change. Yeah. Think of depreciation as cash out the door.
What if you sell it to your FedEx?
It's a real.
Like related party
it's a related
transaction.
party transaction,
Yeah.
and they don't like those.
Yeah.
So even if you're like, we would do it, you sell to us, let's say on like 30%, so they would not reset their depreciation schedule at that point?
Which way did the transaction go?
It's like, well, on 100%, they'll stay on, take on for like 30%, and then go from there. Now inflated sales price, if they bought it whatever, 20 years ago for $1,000.
They're gonna pick up, if they pick up gain, they're gonna get the depreciation on it too. That can get,
When you get
I
to
can
related
see-
parties, there's a lot of rules to go with it that are, we tread lightly with those.
I
We
can
like
see
to-
you have a lot of fun scenarios.
Yes.
It'd be nice to talk to you.
Yeah.
I was just gonna make the comment that, as we're trying to find people that are selling, that might be potential sellers, the depreciation factor is an interesting play to talk to them about, the fact that maybe they bought it 20, 30 years ago, and their depreciation amount is either going away after 27.5 years, or because their original cost times as much, and so if they do a 1031 exchange to another property, then all of a sudden they can depreciate 5, 10 times as much. I had a client that did that, and you know, we kind of looked at it and said, hey, you know, you bought this 25 years ago, it's now worth this much, you're only getting this much tax benefit every year, let's just do a lifetime exchange, and then they could do a big depreciation.
And then you get to defer that gain because your basis is so low in that they probably had a huge gain on their first property that then they don't have to pay in the current year.
That's why talking to property owners that have held properties for a long time, it can be beneficial to have these tax conversations. Encourage them to talk to their CPAs.
Yeah. It's
And-
always good to involve us earlier rather than later.
So that brings up another question. If somebody's looking for CPA or tax help, how can they get a hold of you? Or what, are you guys taking on new clients or?
Do you want to do the spiel?
We are taking new clients. You can go to our website. We have cards here for everybody. Just get in contact us. We'll have a sit-down meeting with you, kind of look at your stuff, see if it's a good fit. If we can supply you with value add and save you money, great. If we can't, then we'll tell you to go somewhere else where you better money. But yeah, we'd love to sit down and chit-chat, look at your stuff, and kind of get a game plan.
And help you grow and everything.
Yeah.
When you say you are a specialty in beverage, is that alcoholic beverages or non-alcoholic?
All fun stuff. So beverages in general. So I work with our breweries, our wineries, as well as I'm working on trying to get in with hop brewers to kind of do a cross niche between agriculture. But my main focus is agriculture. Those are just some of my fun side stuff that I get to do.
Any other questions? Let's,
So I was wondering if you go by sales contract, let's say it's $1 million property, you pay your whatever 6%.
Let's just talk after all this.
You've got fun stories. He's got like that.
let's,
So I'm just curious, where are you located? I'm not familiar with the firm, and are you licensed CPAs for multiple states?
Outside. So we are, so a little bit, I guess, spiel on us. So Printed Stokes has been, 1945 is when we started. We were a Eugene-only firm. We merged in 2018 with Spectrum CPA, who was here in town. We merged with them and became a multi-office firm. So we're in Eugene, Corvallis, Bend, and then we have a remote office in Lake Oswego. So those are kind of our markets. We're out on Northwest Professional. What was your other questions?
Out of state.
Oh, so we're licensed, so we're both licensed CPAs in Oregon. So that just means we do our taxes in Oregon, but we can do other state taxes. So that's actually our specialty, is the more complex the better. We have a lot of clients who have multi-state transactions, multi-state returns, businesses that are founded in other states that do business there, but as long as we're doing our work in Oregon, we're allowed to do your return.
One of my proud moments is our firm has a big flipper, and they have 40 states. They work in 40 states. It's over 1,000 pages, and I just had to crank through it. It's like we have capacity to work in all sorts of states. Now we see a lot of Californias, we see a lot of Arizonas for obvious reasons, but we can go Tennessee, Alabama, New York, and all that kind of stuff.
nobody has any other questions? Let's, and maybe if you do,
We'll stick
grab
around
them
for a
afterwards, but
minute.
yeah, let's thank them for coming. Yeah, so hopefully you guys, you have the ability to stick around for a few minutes, but we're gonna go around the room and Jesse's got 1 or 2 announcements.
Perfect.
Right. Before we go around the room, we're just going to talk about our December meeting. We left the calendar open. There's no presenter for December. And we were planning on focusing on goal planning, so that's yearly strategic planning. And Ryan has a template and a process that he's used through Keller Williams that we'll talk about. And it's one that I've created that I've been using for quite a while too. So we're going to get together and figure out how we're going to blend all that stuff.
Yeah, and maybe present a couple different ways to think about goal setting, planning for next year, you know, really putting on paper what you want to do. And then the second part,
Yeah, and then, but really quick, I'd
Sure.
like to see like how many people have some sort of system. It doesn't matter what it is for planning, for like an annual planning. Does anybody do that now? Okay. So I think that's fantastic because I attribute a lot of